Hello, everyone. This is your halftime report for 2022. Basically, here we are sitting in July, and I'm recording this, let's see, about mid-July. And the goal today is to look back at what happened the first half of the year and what we might expect in the second half of the year. As we all know, it's been a rough start to the year, so let's go ahead and dive in. Let's explore what's happened so far, why it's happened, and what we think is likely to occur going forward. So I'm going to share my screen here, and all right, here we go. Let's rock and roll. Got some tabs here to review with you. First half of the year, I don't know if you saw the news, probably you did. It was the worst half of the year since 1970. So we are talking, this has been a 50-year event. It's kind of interesting. We get these black swan type of events, if you will. I don't know if it's really a black swan event, but it's just been a really bad market year so far. Now, by the way, this should not surprise a lot of us. We've been talking about this for years, that markets were wildly overvalued. And so it's not surprising that we're seeing a rough patch, and it could be anything, anything that kind of tips it. What tipped it, I think, here was a combination of inflation, rising inflation, and war in the Ukraine. Although I don't really think the war in Ukraine is causing a lot of what's happening these days. I think it's more the inflation factor and rising interest rates, what the Fed's doing about it. So let's take a look at kind of where we've been here with inflation. Oh, by the way, when I say the stocks have closed out the worst first half, the large company stocks like S&P 500 down 20%, NASDAQ down 30%, even bonds down 10%, international down 20%, like everything's down 20, 30%, it seems like. Everything's getting killed with one exception. One exception, the only thing not getting slammed in this market, large company, blue chip dividend paying stocks. That's it. Those are the only companies that haven't been hammered. Everybody else has gotten absolutely hammered. So what's going on here? So how did this, let's do a little, go back in the past a little bit to figure out what's going on here. So as you recall, this is the FRED, which is the St. Louis Fed. It's where we get a lot of economic data. This is a chart of money supply since, way back in 1959. And, we all know, like, we were talking about, wow, look how big money supply is growing. And well, it turned out it wasn't growing at all until right here in 2022, COVID hit. Now, when COVID hit, the Fed had about $4 trillion out there in circulation in what's called money supply. And that's, measured in a lot of ways. You can kind of see it here. It's like money. This is M1, it's called, which is, a variety of things. But then COVID hit, and what happened? We had stimulus packages going on. The Fed is printing money, because here's what's going on in COVID. It's like this. It's like we're driving a car down the road, and then we got stuck in mud. The economy basically shut down once COVID hit. And the Fed and the government, they're like, holy cow, the government shut down. We have got to rev the engine. We've got to put the pedal to the metal. We've got to do everything we can to keep this economy going. And as a result, they just start printing money like crazy. And we went from 4 trillion up to, what is this, 16.5 trillion, 4-time growth in like 3 months. It was crazy. I mean, just unprecedented. 3 months, like 4 times the amount of money floating out there suddenly is out there. And they didn't stop. It kept going. Now we're at over 20 trillion. So 5 times. So this, like, check this out. We thought, okay, we're done here. But in just this next period of time, we went from 16 to 20 right here. Holy smokes. That's as much as it had been in from 1960 to in 60 years. So bottom line, holy cow, this is just like printing money like crazy. And that's what the Fed did, because they said, we got to keep this economy rolling. And it worked. The economy kept rolling. But it is no surprise at all that when you're printing a bunch of money, once the car starts moving again, it's going to start to get overheated, thus leading to inflation. That's this right here. Here we have inflation, and it's just kind of cruising right along. But then look what happens. Right here, it starts going around 5% in May of 2021, then up to 5.4, and then bang, in the fall, it starts really shooting up. And right now, you might have seen it. Our last report in June was roughly 9% on all categories, at least how the government measures inflation. We can certainly talk about what real inflation is versus what the government thinks it is, but normally real inflation is higher than what the government thinks it is, right? So inflation's going through the roof. And now the Fed's sitting back and they're saying, all right, the economy's rolling, but we got a problem here. They do not like inflation at 9. They like it, their bench line's right around 3%. That's what they want to see. So how do they fight inflation? What do they have to do? Well, they have to increase interest rates. And in fact, right here, you can kind of see this. This was back in June at the Fed meeting in June. What they had done at the beginning of the year, they said, we probably are going to have to increase rates this year on a measured basis, which means like maybe a quarter of a point every time they get together, like a little bit at a time, incrementally. But here's the problem: inflation's spiking. They're like, holy cow, this incremental approach, that ain't going to cut it. We need to get serious. So they hiked it by 75 basis points, 0.75%, biggest increase since 1994, right? That was in June. That was the month of June. And by the way, the markets got crushed in June because when interest rates go up, honestly, it just makes borrowing money harder, which especially is hard for the NASDAQ, tech companies. Anyway, it just crushed markets. Well, they're not done. Here we are. What do we think is happening here in July, right? This headline: Fed officials, they're expecting another big rate increase in July because basically inflation's still kicking, right? The economy's still overheated. And here it says, well, they say the Fed is well on its way to another sharp interest rate hike in July. That's coming up here. I think their meeting, is like towards the end of the month. Definitely in support of doing another 75 basis point hike in July, maybe another 50 in September. So they aren't done. In fact, I've read that there's a lot of people talking about a full 1% rate hike in July. So 75, 0.75%, 1%. They're not done. That's a key. That this is what you need to take away from this. They're not done. And there is a long-term saying in our industry, in the financial industry, when it comes to markets. And that saying is, don't fight the Fed. When the Fed is raising rates, it's probably going to lead to some tough times in the economy and tough times in the market. So what happens is this: when the Fed increases interest rates, what they're doing is they're saying the economy is overheated. We need to slow it down. We need to slow down the economy. It's like a car that's redlining. It's just going too fast. We got to slow it down. Now, the way they do it is they raise interest rates. So how does increasing interest rates slow down the economy? Well, there's a lot of ways it does it, but I think it can be highlighted right here. What's happened during a period when interest rates are really low is that it's kind of like free money. And a lot of people, especially during COVID, they had a lot of home equity. Housing prices have gone through the roof. They said, hey, let's either sell the house and cash in, or let's do home refinancing. And a lot of people said, we can't go travel. How about this? We need to redo the house. How about we do a home equity loan, take a cash out loan, and then we'll go to Home Depot and Lowe's and we'll hire people and we will fix up the house. And that drove a lot of the economy during COVID. But look what's been happening to mortgage rates. This comes from Freddie Mac. Check this out. Back in September, and in fact, all the way through, here we are. But through the end of September, basically it cost 3% for a 30-year mortgage. Now you had to pay points to get that. And so maybe like my mortgage, I think for 30-year was 3.5%, but you could get around a 3% 30-year mortgage. I mean, look at this. You could get a 15-year mortgage down like 2%. I mean, holy smokes, right? Cool. Free money, basically. Well, what's happened since September? We're talking like 9 months, long enough to have a baby. We went from 3%. Now we're up to here. It was as high as 5.8, but now today we're sitting at 5.5, 15-year, 4.5. Basically, rates have gone up. Well, how does that really affect things? Well, what it does is it makes your mortgage payments higher. And if you look at what's happening in the mortgage industry, refinancing is like nobody's refinancing anymore. Home people applying for new mortgages has cratered. If you look at the home market where it's been a buyer's market, like, hey, put your house on the market and you get to auction it off like the next day and sell it for $100,000 more than your asking price. Yeah, those days are basically gone. In fact, it's already flipped. Most housing markets are already seeing sellers having to reduce prices. Now, as an idea, by the way, my wife and I, we have a house out in New Mexico. We flew into El Paso and we're driving up to our place up in New Mexico. And, we're looking at El Paso. Seems like a lot of growth is happening there. And, we're just playing around, what if we open an office in El Paso? And, where are the good housing areas in El Paso? And so my wife, while we're driving, she just starts Googling, housing prices in New Mexico and to kind of find what areas have nicer areas, and lo and behold, like in El Paso, house prices are dropping like crazy. People are trying to sell their houses. They can't sell them. They're cutting prices. This is happening all over the country. Here in Austin, we're a little bit isolated. We don't see a lot of that yet. But everywhere else, this stuff is happening. House prices aren't going up. They're starting to go down. So that's, no more borrowing means no more fresh money into the economy. That's just one way they lower the economy. So we're at a point now where everybody's expecting recession to happen here in the near future. And the Fed's not done raising rates. So the more they raise rates, the more we're likely going to see a recession. So what does that mean going forward? That's where we are now. What are we doing about it with our client portfolios? And what does that mean going forward? So I've got three great sources of what they think is going to happen in the markets going forward. Here we've got Schwab, right? Here they say, Schwab right here. This is not a market likely to reward excessive risk-taking. We continue to emphasize the importance of diversification, basically focus more on quality-oriented factors right here than traditional style indexes. Basically, they're saying, we don't think things are going to go well for the rest of the year. We think it's going to be really rough, up and down. We've got Investors Business Daily here, which, by the way, great resource. They are saying, hey, a lot of risks still out there. There might be some reasons for hope. Maybe things will turn around, but they are also kind of up in the air. Forbes, they're just saying how to invest right now. With increased uncertainty, reduced risk taking in the portfolio, no big dynamic bets make sense, highlight more in value versus growth, a lot of back and forth. Basically, and I can stop screen sharing here, basically everybody's saying a lot of uncertainty. We don't really know what's going to happen, right? We don't know what's going to happen. So how have we addressed this in our portfolios? If you're paying attention, for the vast majority of you, our portfolios, while we started the year kind of in growth mode, as we've gone through the year and things have gone south, we've been shifting. And ever since May, we've been in really defensive positions. Markets had big drops in June. We haven't seen, we haven't experienced a lot of that because we'd already shifted a lot of assets to more defensive positions. And that's where we hold it now. I'm a big believer, and most of us here in the office who sit on our investment committee, most of us believe that the rest of the year is going to be kind of up and down. And you're seeing this, right? One week the market's up, one week it's down. One day it's up, one day it's down. we really believe that as long as the Fed, here's what we think the markets are going to be like the rest of the year, kind of like this beard here I'm trying to grow, right? For the first time in my life, I'm going to try to grow a beard. It's kind of like this beard. Right now, it's pretty uncertain whether this thing's going to work out or not, right? I mean, it may come in and it may look fantastic and I'll be like, oh, this is great. It may not. And, the next thing you know, poof, off it goes and I'm back to a fresh face, right? No beard. So we'll see where it goes. That's like the market right now. We don't know what's going to happen the rest of the year, but here's what I know. As long as the Fed keeps raising interest rates, I think it's pretty unlikely that you're going to see a lot of boom period in the markets. I don't think they're going to go firing up while the Fed's raising interest rates. I just don't see that. I think we will be seeing a lot of recession fears more and more. I think we are heading towards recession in the fall and into the new year. So these are all not good things. With that being said, it is midterm election season. And every time it's election season, that brings hope. The market really likes it when there is a lot of deadlock in Congress and the Senate. They love it when our government does nothing because it represents a period of certainty, right? If the government can't do anything, then we kind of know what's going to happen. Nothing. So one of the things on the midterms, this is a sign of hope for us, at least as far as this is concerned, is everything at this point indicates that the Republicans will take over either the House or the Senate, maybe both. But regardless, if you can have one party in charge of the presidency, another party at least in charge of either the House or Senate, either one, then nothing happens. I'm going to tell you what, the markets really like that. They really like that idea. So that might bring some hope. It wouldn't surprise me if, through at least the rest of the summer, early fall, markets remain choppy. Maybe, fingers crossed, maybe as we come into the fall, things will start turning around a bit more. So that's kind of what we see. The markets for the rest of the year, very uncertain. We agree with Forbes. We agree with Investors Business Daily and Schwab, pretty much everyone. It's a real up in the air period. And as I wrap this up, like I said, kind of like this beard I'm working on here. It's real uncertain. Is this going to work or not? We'll find out, right? Only time will tell. All right. As always, you have any questions, you're welcome to call us. We're always happy to talk. Hope you enjoyed this little discussion. And, let's hope, keep fingers crossed that the rest of the year kind of works out a little bit better. All right, that's our message. Have a great rest of your day. We'll talk to you again soon.